I'm at 6,800 on gold, and I'm at 180 on silver. I had raised it from 100 to 125. Silver miners, I have a target on SILJ which of 90. If you could get down to 80 on silver, gold normally would be a safe haven. I think it's because the run up in oil really increases. Oil is a big cost factor for mines. Like I said, you might top by Labor Day. I can see a top coming in coming months. And I think in the equity markets, certainly could see it this summer. When that turns into the real sell-off where I'm calling for an 80% bear market, higher grade, investment grade corporates won't be down nearly as much as junk bonds. Private credit will be down because that's a lot of times credit issues show up when the economy gets weak. If we get this global bust, it could take upwards of $20 trillion in new QE coming out of the Fed. They will provide whatever monies are necessary to meet that $250,000 insurance threshold for bank accounts per institution. One area, obviously, that I like a lot, one other area is miners. Because I think gold and silver have big runs here. As I said, I raised my gold target 6,800 in a couple steps. I went to 5,500, I think, in my January letter, and then 6,800 soon thereafter because of what happened in January. So I'm at 6,800 on gold, and I'm at 180 on silver. I had raised it from 100 to 125 in January, and then raised it to 180 after the sell-off in early February. And I think, that you probably know this. There's a couple estimates out there. One in particular, Michael Oliver, who's calling for $300 to $500 in silver this year. I can't get there in my work, but I don't rule it out. Silver's got a lot of upside one way or another, whether it's 180 or whether it's something well above that. I think silver, and as a result, if the metals have that kind of upside in the next 3 to 6 months, that means the miners have a lot of upside. And I think you're going to see the miners in some kind of the silver miners. I have a target on SILJ, which is junior silver miner ETF, of 90. That's down in the low 30s. That's almost a triple from here. And I've got, GDXJ, I think, is selling in the mid 120s, 125, 6.
Retail investors are still chasing AI momentum, while silver miners quietly price in a completely different future. David Hunter notes that moving SILJ from the low 30s toward 90 implies institutions expect a monetary stress cycle far larger than headlines suggest. The overlooked signal is miners outperforming even as mainstream analysts call metals overextended. That divergence usually appears before confidence in central bank credibility weakens. If precious metals accelerate while equities remain euphoric, unhedged retirement portfolios could get blindsided fast. Next, David Hunter exposes why silver's volatility may actually confirm hidden institutional accumulation.
And I think that can go to 250, so that's basically a double. So the miners look strong here. I think there's a lot of upside. They're selling off today. I actually saw this in the charts. It's a short-term sell-off. You could get down to 80 on silver. May not go that far. Go down to 84, I think, this morning. And whether you have more weakness tomorrow and the next day, or tomorrow anyway, or whether this thing reverses from the lows today, I don't know. But downside is at most say $4 or $5, and the upside is big.
Have you been surprised by how they haven't really reacted to this geopolitical sort of situation that we've seen? Normally they're seen as a safe haven, but it hasn't seemed to have acted like that.
Yeah, certainly gold normally would be a safe haven. I think it's because the run up in oil really increases. Oil is a big cost factor for mines. That's one thing. And number two, I just think it's been a risk-on trade, particularly beginning with that December run-up. Gold and silver just took off on a risk-on move. And so I think they're being viewed just like the equity market was during the correction, as risk on trades. And so with the with Iran being the center stage story, it became risk off in both equities and in metals. Obviously, equities have reversed here, so have the metals. They're just not they're not at all time highs yet. They have a long ways to go.
Gold failing to surge during geopolitical panic is exactly the kind of timing anomaly smart money watches closely. According to David Hunter, rising oil costs and speculative positioning temporarily turn metals into risk-on trades instead of safe havens. That matters because distorted correlations often appear late in unstable cycles, right before traditional relationships violently snap back into place. Most retail investors only notice price direction, not why institutional flows suddenly change character underneath the surface. Next, David Hunter reveals why temporary weakness in metals could become the setup for a far larger breakout phase.
I think you'll get there. You might get there this quarter, even, which means the next month and a half. And if not, you'll get there this summer. And you might, like I said, you might top by Labor Day. Doesn't have to. My targets are basically this year, but yeah, I wouldn't be surprised if we have a big run up and get to the highs by Labor Day.
Okay. And then, as you said, that should flow to the miners, and that would be very positive for, yeah, all the gold and silvers.
Yeah.
And after you get to the top on Labor Day, do you see aggressive reversal?
Yeah, I mean, I'm just saying it could get there by Labor Day. I'd be
Yeah.
very careful. I have to guard against this because people hear a word and then all of a sudden you said it would top by Labor Day. No, I didn't. I said it could happen by then. But um, I what I say is, and particularly talking about the equity market, tops are a process. Could we go straight up and straight down? We could. More likely, what historically what you see is that you get up to a top and then it's a process. You might sell off, 5 or 10%, and then go back up, and make a double top, or you might go back up and not quite get there, and then roll over. So it's hard to say exactly when this thing really rolls over hard. It might be, it could be in the fall, it might be in the winter, it could be 2 days after we top.
Markets rarely ring a bell at the top, which is why euphoric headlines become most dangerous near the end of a cycle. What David Hunter is highlighting is that major reversals historically unfold as processes, not instant crashes, allowing institutions time to distribute risk while retail keeps buying optimism. The media focuses on index highs, but ignores deteriorating breadth, leverage, and liquidity underneath the surface. That disconnect punishes investors who mistake temporary rebounds for structural strength. Next, David Hunter unravels why the final rally phase could create the illusion that systemic risk has disappeared.
But I think I can see a top coming in coming months, and I think in the equity markets certainly could see it this summer. Um, when that turns into the real sell off, where I'm calling for an 80% bear market, it doesn't mean it's immediate. It might be that you kind of back and forth for a couple months before you roll over. I don't know. I'm not saying that will be it either. It can take any shape once it makes its stop. So, but either way, I'm pretty certain that, whether it starts later this year or in 27 is going to be a tough year for equities, for the economy, probably for the metals, among other things, for certainly for lesser grade bonds. If we go into a global bust, junk bonds are going to get hit hard. Private credit's going to get hit very hard. Private equity is going to get hit hard. Real estate's going to get hit hard. It's going to be next year. I believe is going to be a 2008-9 story, except maybe worse because of the leverage in the system. Meaning in 2008-9 we had lots of leverage and it caused the real problem we had. Our leverage today is so much beyond what it was in 2008-9, and leverage works both ways. It leverages your good returns on the way up. It really hits an economy and a financial system hard on the way down. So that's why I call this, what's coming, I think, a global bust.
If leverage unwinds the way it did in 2008, passive retirement portfolios could suffer losses most savers never imagined possible. David Hunter's argument suggests today's danger is larger because debt saturation now stretches across private equity, commercial real estate, pensions, and shadow credit simultaneously. The uncomfortable reality is that years of artificially suppressed rates encourage risk everywhere, while convincing the public volatility had been permanently contained. When liquidity finally reverses, diversification alone may not protect capital the way investors expect. Next, David Hunter reveals which safe assets may actually depend entirely on emergency money printing to survive.
Yeah, and do you see that in private credit, or do you see that in all sort of credit markets?
Pretty much across the board. Like I said, other than treasuries and very high grade corporate where they have total control over their balance sheet, they will be maybe okay. Treasuries for sure, because of the printing press and the government backing, will be one of the assets that could hold up in the bust. Most things are going to be down and down hard, depending on, higher grade investment grade corporates won't be down nearly as much as, junk bonds. Uh, Private credit will be down because that's, a lot of times credit issues show up when the economy gets weak. So private credit will have some struggles. I would also say, as I said, private equity will too. I would also say pension funds are going to have big troubles. All their alternative investments are going to hit them, and as well as the equity market, as well as the bond market outside of treasuries. So there's once the tide goes out, you're going to see a lot of hurting boats. You're going to see what's underneath the water.
Yeah, I'll be interested to see who the government then decides to save. Because you imagine pensions, probably financials, but then all this shadow banking and private credit and private equity probably gets thrown out.
And again, this is just a total guess, seat of the pants, but I've said for many years, if we get this global bust, it could take upwards of $20 trillion in new QE coming out of the Fed.
The market keeps treating private credit as stable income, even while liquidity conditions quietly deteriorate underneath it. This is where David Hunter's thesis shifts from market correction to systemic rescue operation, because a $20 trillion QE response would imply policymakers already understand how fragile leverage finance has become. Pension exposure, shadow banking risk, and illiquid private assets are rarely discussed honestly until losses force emergency intervention. By then, ordinary savers usually discover the safe yield narrative was built on cheap money assumptions. Next, David Hunter exposes why future bailouts may protect institutions long before they protect households.
And similar amounts around the world from the central banks around the world. So it could be 50 trillion or more around the world. If you're printing 20 trillion of new money, and again, we printed 5 trillion in response to the pandemic. We printed 3.7 trillion post 2008-9. And the balance sheet in 2008, going into the great financial crisis, was 875 billion. We've gone from 875 billion, which was the largest it had ever been, going back to 1913 when the Fed was created, and all of a sudden we went to 9 trillion, in 2021 or two. It just shows you how we've expanded the balance sheet of the Fed. And I'm saying that you could see it up to 30 trillion in response to the bust. If you print that kind of money, you're going to be bailing out a lot of things because you got to find places for that money. You're going to be, as I tell people when they say, well, where can you park your money to be safe? And I go, treasuries are government guaranteed. They've got the printing press. So that's one place where I think it'll hold up and probably appreciate during because interest rates are going to be falling. But, FDIC insured bank accounts, I guarantee you, I mean, this, because of the printing press, I can state pretty confidently, they will provide whatever monies are necessary to meet that $250,000 insurance threshold for bank accounts per institution. So you're okay at 250 per institution. But if you get beyond that, or if you're in money market funds that don't have that backstop, etc.
The Federal Reserve keeps talking about discipline, while its balance sheet history tells the exact opposite story. According to David Hunter, the Fed expanded from an $875 billion balance sheet before 2008 to nearly $9 trillion within little more than a decade, exposing how crisis management now depends on perpetual monetary expansion. That creates a dangerous illusion of safety, because guarantees only work as long as confidence in currency stability survives. Savers holding excess cash may discover protection against collapse becomes exposure to long-term devaluation instead. Next, David Hunter exposes why safe cash could quietly become one of the most vulnerable positions in the next cycle.
If you're printing 20 trillion, you can pretty much guess, just like they did in 2008-9, they are going to backstop it. Because the purpose of printing that money is to try to turn the economy around. If you save some things and let the consumer just drop because they lost money in the money market or they lost money in the bank or whatever, you've defeated your purpose. So the odds are pretty high that there are going to be bailouts left and right, one way or the other. But they aren't sure things. I can say that, but there's nothing that says that has to happen. Whereas with treasuries, it's pretty much a government guarantee. So the government will back that. And with FDI insurance, it's pretty much, I would feel very confident saying they'll back that. So it's the other things that are question marks, but my guess is we thought 2008-9 was an amazing period of bailouts and things. This time, I think we'll make that look like a small change.
Yeah, in 2008, they bailed out the banks and sort of let the consumer struggle. And I don't think they can get away with that again without a social revolution. I imagine that would be extremely unpopular.
And they did do things for the consumer, just not. I think they'll do more this time. The not break a buck in the money market, that was for the consumer. That was there. But yeah, the banks were kind of front and center. They bailed out the banks. Technically, they certainly let them go to zero, but didn't let them go under. And I think you'll see something similar this time.
The last major bailout cycle protected banks first, and policymakers still haven't solved the political consequences from that decision. What David Hunter is highlighting is that future rescues may need to arrive faster and broader because public tolerance for another Wall Street first response has collapsed since 2008. Timing matters here because governments only expand guarantees aggressively when they fear confidence itself is breaking underneath the economy. Investors assuming money markets or uninsured assets are automatically protected could learn those decisions remain political, not automatic. Next, David Hunter unravels why the next rescue package may expose how fragile the banking system already is behind closed doors.
Now, overseas, it's a different story. I think it'll parallel us to some extent, but there are different bank laws over there, et cetera. So, bail-ins may be a bigger deal over there. They've certainly got a precedent for doing that there. I don't expect bail-ins here. It'll, like I said, I think the government will step in.
Okay, super interesting. And what would you say at the moment is your most contrarian, sort of prediction currently?
I would say it's bonds. I mean, everybody and his brother assumes rates are going up, and I'm calling for not only rates to go down. I'm saying that between now and the end of the year, you might see 3% or below on the 10-year, maybe even 2.5%, and that next year you'll see 0 on the 10-year, negative rates on short rates. In other words, in 2021, I guess it was, rates got down to, maybe it's 2020, rates got down to 0.4% on the 10-year, during the pandemic. And everybody's assumed that that's a low water mark on rates, that the bond market had its highs. You saw the secular peak then. And I'm saying there's one more higher high in bonds if you go to 0 on the 10-year and a quarter or a half on the 30-year, and 5-year will be, 0 or below. That basically you're making one final bull market top, secular bull market top. The interest rates started their secular bull market in 1981.
Markets keep pricing higher rates while bond traders quietly prepare for the exact opposite outcome. David Hunter's argument suggests the real shock ahead may not be inflation first, but a deflationary panic strong enough to force yields back towards zero despite today's hawkish rhetoric. That directly contradicts the mainstream narrative that central banks permanently lost control of long-duration bonds after 2022. If rates collapse again, institutional capital could rotate violently before retail investors even recognize the macro regime change. Next, David Hunter reveals why the final bond rally could become the warning signal for a much larger economic breakdown.
Rates were 15% on the 10-year back then and the 30-year, and we've come all the way down. We got down in 2020 and then, backed up here to where we are now, 4.5. And I think you'll fall to a new lower low below that 0.4 down to 0, and the 30-year, which in 2020 I think got down to under 1, it was 0.8 or 9, will fall to 0.5% or 0.25%. So it's and that will mark, in my opinion, a final high in bond market, secular bull market top in bonds. Just like I think the coming stock market top will be a 44-year secular bull market top in the stock market. And then I think, the bust will take us down big time in stocks. And then the recovery following, because of all the money printing, will give us a big inflation cycle. It'll start slow, but then it'll pick up speed as we go through the decade and into the next decade. And that means, interest rates will go from 0. I think they could go all the way to 20% or higher. So over the course of 6 or 7 years. So, you're gonna go from a, finishing touches to a long secular bull market in bonds to a very, very nasty secular bear market in bonds over the course of the next decade or less.
Okay, super interesting. So, David, thanks so much for your time today. We've covered so much. But my last question is, what is one message people should take away from the conversation?
If rates eventually swing from near zero toward double digits, most traditional portfolio models break completely. This is where David Hunter's thesis shifts from short-term crisis management to a long-term currency credibility problem, fueled by relentless money creation after the downturn. The hidden risk is that investors conditioned by 4 decades of falling yields may stay psychologically anchored to a world that no longer exists. Pension funds, bond-heavy retirees, and passive savers could face losses from both inflation and collapsing purchasing power simultaneously. Next, David Hunter exposes why the coming inflation cycle may begin quietly before accelerating beyond central bank control.
Yeah, I would say just be careful. We're in the last stages of this, as exciting as it is, and as much as I have numbers way above anybody else on the street, 9,500 could soon be 10,000 on the S&P, and that's still, 25% or more away. Don't get caught up in this and think you're going to hear at the top, I'll be turning bearish, but you're going to hear at the top people telling you this thing has years to run, that they'll give you all kinds of good story on AI. They'll give you a good story on, interest rates coming down and oil coming down, and that we're kind of in the great new world where you can have your cake and eat it too. You're going to have all kinds of good stories, probably in response to the Iran war ending. I think that's going to give us that final spurt. And it's going to be hard to argue with the good news. It's not going to be easy to sell at the top. So I just caution people. I think you're months away from a top, meaning could be this summer.
The most dangerous market phase usually arrives when optimism suddenly sounds intelligent and completely reasonable. David Hunter notes that powerful narratives around AI, falling oil, and easing rates could push equities into a final euphoric surge even while systemic risks continue building underneath the surface. That's how late cycle tops trap investors. Institutions distribute quietly, while financial media amplifies stories explaining why this time is different. The public rarely notices liquidity stress until after the reversal begins, and exits become crowded simultaneously.